So this is something that the Philly Fed has been tracking for a dozen years, maybe even longer. Maybe it's 20 years. And they look at four state level variables for all 50 states. It's non-farm payroll, it's average hours worked in manufacturing, it's unemployment, and it's wage and salary offset by CPI. And as it turns out, taking this list of indicators and breaking it down on a state by state basis gives you a great snapshot, not of things that are lagging or leading, but here's the state of the economy today. And so I like to look at it and compare it over time. And, you go back to a few years ago when 49 states were expanding and one state was neutral. You go back 12 months ago, the same period, they look at a 3-month trailing period. And a year ago, 30 states were expanding, 13 were contracting, and 7 were stable. That has fallen quite a bit. Now, half the states, 25, are expanding, 21 are decreasing, and 4 are flat. And what this is telling us, following 18 months of Fed rate hikes, is that the hikes are biting, and overall, the U.S. economy is beginning to slow. We are not in a contraction yet. We're certainly not in a recession, and economists have been incorrectly forecasting a recession for, it seems like 2 years. This is quantitative evidence that, hey, we are slowing, and the question is, when does this stop? If this continues to slow, then you'll see rate cuts. And if this stabilizes or starts to expand again, then don't expect rate cuts all that soon.
It's interesting just kind of looking at it on a state-by-state basis. I'm less concerned if Wyoming's slowing or even in a recession than I am, say, Texas or California or Florida or New York. So how's the regionality here?
So Florida, Texas, California has been doing fairly well. A year ago, New York was as deep into the expansion as it gets. New York is now flat this year. This month, I'm sorry, the November 2023, the trailing 3 months. And that's pretty much because you're seeing a slowdown in real estate. The previous year, you saw a slowdown in finance, although obviously last year wasn't too terrible. And some other industries in New York just have been doing okay, not great.
It's interesting. Do you think the Fed looks at it on a state or even a regional basis when it's looking at the state of the U.S. economy, or you think they just look at the national numbers and go policy making from there?
So some of the researchers at the Fed pay attention to this, not just the researchers in the Philly Fed, but the Federal Reserve in D.C. This is a data point that people look at. And, I know Jerome Powell likes to look at leading indicators to kind of give him a heads up as to what's happening. When we look at coincident indexes, sometimes you have to go a step or two away. Hey, what's going on with wages? What's going on with unemployment? And you'll notice a lot of the areas that are slowing down, a big part of that slowdown is driven not by commercial, but residential real estate. And when you see, people forget how giant a driver of the economy real estate is, not just the transaction in the house, what the builders get, what the real estate agent gets, but all the data shows that when someone buys a new house, they tend to decorate, they buy furniture. Very often they'll buy a second or a new car. They'll do all these things that are highly stimulative of the economy. And so the greatest argument you can make for why the Fed should ease off on where rates are is simply, hey, we have a I don't want to even call it a bubble. We have a shortage of houses which have driven prices up. You've put the kibosh on that. All the builders are working overtime to catch up on the supply issue, but you've also accidentally locked people in place, because if you have a 4% or a 3% mortgage, it's too expensive to move and get a 7% mortgage. You need to let rates come back down somewhere in the fives to bring on more supply and reduce that mayhem we've seen in the real estate space. So it's worth looking at this. I don't think it's the prime driver of Fed decisions, but it's certainly something that gives us some insight into, hey, if this keeps slowing down, if this continues on the path it's been since the Fed began raising rates, I'm not in the recession camp, but it's not that hard to see. Allow this to continue to get worse and worse, and you're going to make a recession inevitable. At a certain point, the Fed is going to have to say, hey, we're about to have a recession. We have to do something. And keep in mind, this is an election year. Yep. They don't like to cut rates in September, October, November. Really, we have till the middle of the summer before they are in that sort of no-fly zone because of politics.
30 seconds, Barry. Any theme that you're looking for 2024?
No, the fact that the Earth is in the same place relative to the sun it was 12 months ago has no impact on the economy, the stock market, anything else. It's just think of a series of successive here and nows. Great run last year, amazing run. Historically, that tends to continue. We tend to see momentum sustain itself. Let's hope the first 2 days of the year were a little aberrational.